Okay, so today what I wanted to do is I wanted to do a review of what we covered yesterday. So yesterday we're getting into the investments of either, we're gonna either invest money in shares or we're gonna invest them in bonds. Okay, so let's just review the two questions, or two of the questions that were assigned yesterday, and we'll go on to another, not another topic, just another chance for us to do some more questions again on non-strategic investments. So, if we start with QS 15.3, okay, let's read the scenario. On May 2nd, 2020, Systematic Industries acquired 1,200 common shares at $40.50 per share. Okay, so Systematic acquired common shares of Computer Gaming. Okay, so what we need to do there is figure out what's the dollar value in total. So 1,200 shares times $40.50 is 48,600. Okay, so that's our first entry for May 2nd. Now, their intent is to hold these shares within 8 to 10 months. So that tells us it's a non-strategic investment. Okay, 8 to 10 months. It's going to be a current asset, and we like it this way because there's just less complicated recording. Okay, so again, the giveaway here that it's a non-strategic investment is that they plan to hold it for less than a year. Otherwise, we would have said, okay, well, if we don't know how long they're going to hold it for, 1,200 shares, we would have to calculate, okay, is 1,200 shares less than 20%? And if it is, or less than 20% of the shares outstanding, then it would be a non-strategic investment. Okay, so again, anyways, that triggers the first entry. Now, on August 7th, okay, what happens? Well, they receive a dividend, 50 cents a share. Okay, so again, we're going to have dividend income, and it'll be cash, and dividend income. Okay, and how much will that be? 50 cents times 1,200, so that'll be $600. Okay, how do we get that? The 50-cent dividend times 1,200 shares owned. Okay, so those are the two journal entries for 15.3. Now, usually what also happens is we have to do a fair value adjustment at the end of the year. Okay, so there is not one that's related to QS 15.3. So let's go to QS 15.4. So that solves QS 15.3. Let's go to 15.4. So let's just say we buy all these shares. We buy Zelco shares, IMC shares, and Petra shares. We bought them for $102,540.96. Okay, so that's kind of an equivalent of what this journal entry would have looked like. Okay, now maybe we might have received some dividend income throughout the year. Now December 31st comes along, we have to make our year-end adjusting entry. Why? Because our book value is 102, but we always need to adjust the fair market value. So we find out that the Zelco shares are now, our Zelco shares are now worth 98,000. That is a loss of 4,000. 102 minus 98. So what we have to do is we have to bring our investment down to $98,000. Okay, IMC, it's gone up from 540 to 547, and Petra has gone down $48,000. So again, we've calculated that. We know that altogether, it's a loss of $45,000. So you'll see in the textbook, what their answer does is they just net it out, okay? Now you can do that, it's up to you, but if you're struggling, I would do each one separate, okay? So how is that going to look? So I'm just gonna erase QS 15.3 again, because if we can do the opening entry and the entry to record the dividend income, our fair value adjustment should be fairly straightforward as well. Okay, so what we are going to do then is for each investment, we're gonna adjust to fair market value. okay? So in this case here, we're gonna have, now, again, I don't like the terminology that the textbook uses, but they're gonna just say investment income or loss. I would say unrealized investment loss or unrealized investment gain. Okay. Now, why? Because it's unrealized, we haven't sold it. Anyways, let's get into Zalco. So we're gonna have investment loss as a debit, and we're gonna credit investment Zalco. How much? $4,000. So when we initially bought these Zalco shares, okay, it would have been debit investment Zalco 102, credit cash. Now we make our fair value adjustment, okay? Notice Zalco we have to bring it down, right? Bring down that book value down to $98,000. That's how we do it, okay? So we're good with Zalco. Now IMC has a gain, so we're actually going to add to the investment. Debit investment IMC, okay, for $7,000, so that's going to bring it up. And we have investment income. Okay. We have to, when we're recording these entries, we have to signify, okay, what investment we are debiting or crediting, okay? We can't just put it all to the same investment. Now lastly, for Petra, okay, we have a loss of 48,000. It looks just like this entry here. Debit investment loss 48,000, and credit investment in Petra. Okay. So that again makes our journal entry and our adjusting journal entry to our investments at fair market value. Okay. So QS 15.3, QS 15.4, to me they're fairly straightforward once you get the handle of it. Again, you always got to record your investment being bought, record your dividend income, then record your investment. You got to adjust the fair market value at the end of your fiscal year. Now, you also need to be able to know how to record the gain or loss on the sale of investment. Okay, so that's a review of 15.3, QS 15.3 and QS 15.4. Okay, so again, there's a couple more questions that are assigned, same thing that we need to do, okay, just like this. Now, let's go to, I assigned exercise 15.1. So this is a fairly typical question that you would see on an exam. Why? Because you're required to make all the journal entries for a non-strategic investment. Okay. Now on the exam, it'll just be a bunch of scenarios, and you'll have to determine yourself: is it a strategic or is it a non-strategic investment? But for our purposes right now, we know that it is a strategic or non-strategic investment. Okay, so let's just look at a couple of the answers. Okay, I'm just gonna scroll to the answer key. My setup is not how I would like it to be, but we gotta make do, I guess. All right. It's a 15.1's a long one, so I'm not going to go over every entry, okay? But I'd like to show you how it works. So again, follow along with your answer key, exercise 15.1, okay? So we already know it's a non-strategic investment. All right, so May 1st, we paid $69,980 to purchase a $69,000 two-year 8% bond payable, okay? Dated March 1st. Interest is paid quarterly. They intend to trade the bond, actively trade those bond purchases If they're actively trading, you already know it's a non-strategic investment. So what we're gonna do, debit investment bond, credit cash in the amount of $69,980. Okay, now we always got to be aware that there's an interest payment, a quarterly interest payment. So what's that quarterly interest payment going to be? Well, why don't they say it's a 8% bond payable? Now, that is the market rate. Is that a market rate? No. The bond is paying 8%. The market rate in our case must be less than the bond rate. Why? Because we're paying more than the face value. Okay. So the interest on that is going to be 69,000 times 8% times 1/4. Okay. That'll be your quarterly interest journal entry. Okay. June 1st, September 1st, so on and on and on. Okay. Now, April 16th, we bought 2,450 common shares of Brandon Motors at $30 a piece. Okay. Debit investment. In this case, Brandon Motors. Credit cash. Okay. So again, 73,500 is the amount. How do we get that answer? Well, $30 times 2,450. Okay. May 2nd, we bought another bond. Okay. Same thing as this entry here. Debit investment in Collingwood Corporation bond. Debit 47,968 credit cash. Okay, and they're going to receive interest every April 30th. And no, on April 30th it would be debit cash, credit, interest, income. Okay. Now we don't have to worry about taking a quarter year or a half year. Why? Because they just said they pay it on a yearly basis. Okay. Now, June 1st comes along, they get their quarterly interest payment from this bond here, right? Again, like I say, debit cash, credit, interest, income, 1,380. So you're just filling, basically, you're filling in the blanks. Okay. And then you just keep on recording these entries. Okay. August 1st, they declare a dividend. Okay. So you're gonna have debit, dividend receivable, credit, dividend income. Okay. Then on August 15th, when you get paid, okay, it'll be credit cash, debit cash, credit, dividend receivable. Okay. Now the textbook says no entry. You don't have to record it on the data declaration. Okay. Now some people might record it as a dividend receivable on that date. Some people just might make no entry. I prefer to make the entry. Okay. But if you make the entry, you got to remember to clear the receivable. Okay. So again, you're just going down the line of these transactions. Now, again, on September 1st, Action Corporation, they received a check from Action Corporation again. So it's this journal entry right here, just on September 1st. Okay. Now they purchased 25,900 Dauphin Inc. common shares at $3.20. Okay, debit investment Dauphin, credit cash. Okay, and the amount of $82,880. Okay, again, nothing too crazy here with these scenarios, but again, they will be on the exam. So I just want you to be very familiar with how to make all the entries, which has been given. Now, the only thing that you might say, wow, how do we even record such a thing? It says, December 1st, sold the Action Corporation bond at 101. The dollar value there, okay, at 101 is, now I would never ask you to calculate, I would never use that terminology, but what they're meaning is if the face value is 69,000, okay, if they sold it at 101, it's basically times 1.01, okay? So if you take your calculator, what's that amount? 69,000 times 1.01, 69,690. Okay, so they made a little bit of a profit, 690 bucks. Why? Because they originally, or no, they have a loss, right? Yeah, it's a loss of 290. Okay, 69,690. They bought it for 69,980. Okay, so they have a slight loss there. They're gonna debit your cash, 69,690. Credit your investment in the Action bond, and then the difference is your debit to your investment loss of 290 bucks. Again, on the 30th, you're going to accrue, on the 31st of December, okay, per this journal entry, you're going to accrue some interest on the $49,000. The bond here, where is it? On the May 2nd bond, okay, so you're gonna accrue that interest, okay, that interest is gonna be for 8 months, okay, and then you're gonna make your December 31st fair value adjustment, okay? So again, it's pretty straightforward. Look at the answer key. This will help you a little bit, and on Wednesday, we will get going dealing with strategic investments and how the recording differs from a non-strategic investments. If anyone has any questions, please let me know. Again, I've been getting some feedback from people about the speed of the course. I just don't know, right? Because I've never done this before, you've never done this before. If we're in a classroom setting, it's a lot easier. You can devote yourself strictly to the course. I understand you can't right now. So again, I'm gonna slow the course down. We're making up a lot of time now. So that'll be good, but again, like I say, last week I found I was going a little bit fast, so again, we're gonna slow things down a bit. So we got a couple questions for review today, and again, on Wednesday, we will start up again with continuing on in chapter 15. All right, have a good day.